Hey everyone, my name is Jack. Welcome back to the channel. I cover a variety of topics as they relate to real estate, the markets, investing, and pretty much everything as it has to do with personal finance. So if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. But today I want to do a follow-up to the real estate math video that I did recently, where I actually did a pen and paper breakdown of a hypothetical rental property to show you how easy it is to actually run the numbers on a property. Definitely check that one out if you're new to real estate metrics and want to just see a very simple way to break down the numbers on a property. But in that video, I kind of glanced over cap rate, which is a relatively important concept, especially in the commercial real estate space, not so much in residential, but it can be very important there as well. And I wanted to take the time to actually go over what cap rate is and how it's actually used in practice. Even if you never use it for yourself, it's good to know what it is, so when other people talk about it, you sound like you know what you're doing. Cap rate is short for capitalization rate, and it's used as a pricing tool in real estate to figure out what a building approximately is worth based on its income. This is different than something like a house, where it's typically priced based on comparables and what other properties like it are selling for, since it doesn't really matter what income potential that house has. What matters instead is what houses similar to it have sold for recently. Cap rate actually tries to do a similar thing, only on the income side of properties, where it tries to figure out what a property with that sort of income should probably be priced at based on its quality and the risk associated with it. Now, cap rate is derived from this formula. That's net operating income, or your NOI, divided by the purchase price. Your NOI is simply the net of your income and expenses on the building before any taxes or loan payments. So looking at this formula, you can actually look at a cap rate like a sort of unleveraged return number, where if you went and bought the property with all cash, you didn't have a loan payment, and then you didn't factor in appreciation or taxes or anything like that, this would be about what your return on the property would be. That's pretty unrealistic, because in most cases, when you're investing in real estate, you're probably going to be using some sort of debt, and that's going to drastically change the returns. But cap rate is still there as a benchmark. But how is it actually used in practice most of the time? Well, let's look at that equation again. We have NOI over purchase price equals the cap rate. Well, if we switch this around a bit, all of a sudden we get NOI divided by the cap rate equals the price of the property. So you can see that depending on your cap rate, you can drastically change the estimated price of the property if you're trying to figure out what a good purchase price is. Because typically going into a deal, you're going to know about what the income potential of that building is. If it's already occupied, you know what the income is, and you probably have an idea of what market rents are if you're trying to bump rents for some reason. So you kind of have an idea there. Now, to figure out what the estimated cap rate is, you're going to look at that property's characteristics and see how it compares to other properties in that market. Every market's going to have different cap rates, and every type of property is going to have a different sort of cap rate. For example, properties on one side of the town that maybe have good income potential but are otherwise in a high-risk area, and the properties have a lot of maintenance issues and there's just generally a lot of risk, those properties are probably going to have pretty high cap rates compared to the nicer side of town that has a lot of demand, it's growing, and it's comparatively low risk. The appropriate cap rate really follows the risk-reward paradigm. That is, the riskier the property, generally, the higher cap rate you're going to demand if you're going to be buying it. That's why in hot markets or in markets where prices are appreciating, you're typically going to see the cap rate start to compress and move downwards as that market continues to develop and get hot. That's because you'd probably expect the price of the building to go up over time as more people want to move to this area. It's comparatively low risk compared to some other market that might be shrinking and has other risk factors driving cap rates up. So just to clarify, as prices go up, we'd expect cap rates to go down and vice versa. And as we see cap rates rise, we're going to see prices lower and vice versa. So let's go through an example. Let's say you find a 5-unit apartment building that currently has about a $40,000 net operating income per year. You're trying to figure out what an appropriate cap rate would be for this property based on its current income. The property's in pretty good shape, so it's not really going to need a lot of work. It's in a pretty decent market that's growing very slowly but steadily, and there's a neighboring apartment complex that needed a little bit more work than yours, but it recently sold at a 9% cap rate. On the flip side, there's a slightly nicer apartment complex than yours with similar income characteristics that sold for a 7% cap rate. And as you look at comparable sales in the neighborhood, they're all selling for about 7 to 9% cap rates. Because this one still needs a little bit of work, you decide to settle on an 8% cap rate to figure out what the ballpark price of this property probably should be. So you take your NOI of $40,000 per year and divide it by your 8% estimated cap rate. That spits out a price of $500,000, so that would about be the market price for a building like this with this sort of characteristics and this income potential. So that's really how cap rate is generally used. It's used as a pricing tool based on the income of the property to figure out what that income stream, the property, is actually worth. Cap rates are definitely a subjective measure. They're really trying to capture what the risk-reward trade-off is on a property, and you're sort of projecting the future for as to what you think the market's going to do there, and that's going to affect cap rates, so they do change all the time. And it might depend on what the seller's doing as well. If they're under a lot of pressure, they might raise that cap rate for you, and you'll get a better deal on the property over the long run. But in a competitive market that has a lot of comparable properties, you're probably going to see pretty steady cap rates across the board for certain types of property. So that's what a cap rate is. I hope that answers any questions that might have been raised by my previous video about real estate math. And if you're new to the channel and haven't seen that one yet, thanks for sticking around and checking out my channel. I have more videos on real estate, investing, and calculations and all that great stuff. So definitely have a look around the channel. And if you like what you see, again, please be sure to subscribe. But anyways, that's all I've got for today. If you like this video, please like it since it helps the channel out a lot. And again, subscribe so you don't miss any new updates. I put out new videos every single week and have plenty of real estate content in the works. And speaking of real estate content, definitely check out my book, The One Property Retirement, about a simple strategy for building your retirement nest egg using real estate. And it's very good for beginners who might be unfamiliar with the process. It walks you through finding a property, vetting the deal, actually getting it through the closing process, and then actually maintaining the property and managing it after that. So it's really great if you're new to real estate, or even if you have a little bit of experience, for helping you to get a better perspective on the industry and actually getting started with real estate. If you end up buying a copy and reading it, I'd very much appreciate your review on Amazon, as that would help me a lot. But until next time, take care.